So, good morning, active traders, and welcome to our live Trading Week Ahead broadcast. I'm Ken Calhoun, your host, coming at you live straight out of Colorado here in the US of A. Great to see so many new faces on board. As always, all information's for educational use only. You may have seen me at money show events. Trying my best to, from volatility standpoint, learn from people like John Bollinger and Tom Sosnov, the two top volatility experts I know in the industry. That's what your market's all about. Anyway, let's start off by taking a quick look at our S&P as we get underway with today's session. And for the first time ever, we broke the 5,800 trader mark today. So thank you for being here, making this the most popular event in the history of the trading industry. I appreciate the epic turnout. So what's going on with the S&P? Big picture, we're getting a first red week in a month, and so we are in official pullback mode in the stock market. However, the but is I don't see big honking red candles like we saw the last time we got a drop. What I'd like to see is a candle of at least this height, like this small, followed by a large whole body red candle, then the big epic drop. What we're seeing here is some bullish support because of the fact we've got those bullish tails despite them being red candles. So we're not in full bear mode yet unless we lose that 3090 support in the S&P moving forward. In the meantime, we want to take a look at which sectors and individual stocks are the strongest in our current markets. If we do a top-down sector approach, oil and gold are both doing nothing much. So crude's been trying to bounce a little bit. UWT was up recently, but it's not a sustained run. Biotechs, notice please the breakout strength of the NBI, our NASDAQ biotech. You can see pretty strong relative strength in that, and the DRG, the pharmaceutical, the New York Stock Exchange. Yeah, pretty healthy as well. We take a look at some of the other sectors, we don't see the same relative strength, like insurance. It's been selling off for a month. Finance and banking, also relatively weak. So, as a trader, you want to make money by figuring out where the money is going next. It's always about the next money flow. So until a pullback proves us wrong, biotechs are the strongest. Biotechs, pharmaceutical, healthcare, stock charts like CVS. Health and biotechs continue to be healthy despite the stock market pullback that we're starting to see right now. So that may be a defensive trading play. What I like about CVS is the consistency of the breakout. It's gone all the way from 60 to 76 without any major pullback, save for this one. For those of you who trade cheaper charts, things that are consistent, like one of my small cap scans winning picks from last week, the best one was ATRS. Really good, spectacular momentum run up all the way to just under 5. So if you are trading our current markets, be sure that you selectively focus on the charts that have the best profit potential based on their consistency and how clean and tight the breakout run is and what's an uncertain market, right? We've had a relatively steady bubble up market, but we want to see charts that are even better than the market because we may get a pullback coming up soon. My biggest personal failed missed trade was Ameritrade. I had bought here and I sold here on a pullback because I was really conservative, because usually big gaps down tend to continue on down with that particular pattern with the strength of the red here. So I got out here. I failed to re-enter here and it ran up, of course, without me. And then of course there's a buyout rumor of Schwab. That puts another 7-8 points on the table that I completely missed out on. How many of you, show of hands, have ever screwed up like that? You put on a trade, you were directionally correct, and I hope that you folks benefited, because here in these Trading Week Ahead events, I called the long down there, and sure enough, it ran up, 33, 43, about 18 points or whatever, 15 points off the low. But how many of you have ever been directionally correct in your trades, but you got shaken out and you missed the big profitable run? I still do that after 20 years. So I guess the bad news is, that'll still happen no matter how many millions of dollars worth of stuff you've traded over the centuries. But the good news is, at least I kept a tight stop and I didn't get stopped out for anything significant, but I did miss out. But better that than the other. You have big wins, big stops, small wins, and small stops are the four options. And as a trader, you got to get rid of big stops. So I took a small stop, but my failure was to re-enter. But I hope that some of you profited from that. I've seen a lot of comments saying that. The moving average, a question about the moving averages. I use the 50, the 100, and the 200 simple moving average line. And the 200 SMA is always the exit target, best case for a bounce play. So if you get a recovery play from wherever you get in and you get as high as the 200 SMA, good time to take profit off the table, right? But one thing I hope that as we work together and we share this journey as active traders together, we're looking for the next big play and then kind of a community-based approach for active trading intelligent charts. Here's another good one. MVT was a call for my members earlier, and you can see it ran out of a congestion base of 8 up to 970. It's kind of slowing down with the shooting star here, and it's not able to take out new highs. A price that proves the long's wrong would be a loss of the shooting star low down here near 945 or so, 940. A rebuy would be somewhere over 10, but it's kind of pausing. We've seen a lot of that stop and start price action in our current markets. We've got nice big breakout runners that are wins, and then a pullback or consolidation, then a stair-stepping breakout run that continues, like we saw in the broad market. Now, if we take a look at our market internals, one thing I like to cover for my traders routinely is things like the VIX. And in my live room, we cover the trend, more correctly known as the ARMS index, after Henry Arms, who created it back in the 60s. But make sure that you're using the trend as kind of a navigational guide for long or short bias in the markets. If we're under one, it's a long bias. If we're over one, it's a short bias. You may want to see my YouTube videos on the topic. The trend is important in the VIX. As day traders, you always want to, and swing traders, it's important to understand, like with options, we have implied volatility. In our trading the underlying, we're looking for directional volatility. So what's most likely to keep going up? And when is good enough, right? Ameritrade, I'd be thrilled to sell the high up here. So some of my biggest money, real money trades on swing trades have been selling gaps up that start to fade. So if you're fortunate enough to be long in Ameritrade and it starts to roll back down here, maybe time to sell it if it loses 47, right? And I want you to develop an intelligent rules-based approach that makes sense. For the fellow contrarians out there, us skeptical bears have had a hard time of it the last month, right? But at some point we will be proven right. Note that the SQQs have 4 green days in a row. So I will be scaling in if it breaks north of 27 and 28. Hey, Mira, thanks. Hey, Bob. Hey, good point. I'm reading some of the comments here. Hey, Mira, Wendy, Frank, Matt, Mukesh, Eric, John. Yeah, Eric saying not a screw up, simply playing the probabilities. Yeah, but it still bothers me to miss big ones. Again, you can't second guess yourself as a trader, but I'm not going to miss big bounces in the inverses when the market sells off because, like I should have done in Ameritrade, I've got buy stop orders I got several buy stop orders in place, like rungs in a ladder. You put in buy stop orders to buy on any recovery, right? Because if you look at some of these charts with monster sell-offs, the reason you need to prepare ahead of time is because when, like this time last year, SQQQ was $80 a share. Now it's way down at 26, right? SOXS is another favorite. And the VIX ETNs like VXX and TVIX and whatnot, if they ever recover. The trick to trading these things correctly is to put in buy stop orders with trailing stops, maybe conditional orders, but put in a sequence of 2 or 3 orders every couple 3 points for a swing trade. And if you're day trading, you want to make sure that you're looking at setting those signals up in the pre-market before the market opens, because there's plenty of profit potential in these charts if they run. If we take a look at some of our intraday charts, so you can see SQQQ almost a bullish engulfing, not quite, but not a bullish engulfing because it's not after a downtrend, but an engulfment, and it did poke its head above previous day's high, which is a show of strength for our inverse SQQQ instrument. Just like if you look at the spiders, they did the exact inverse, right? Chopped around in the early part of the day. Boring open yesterday, right? Finally capitulated and dropped down to exact previous day's support before bouncing up for a relatively flat close, just 0.04% off from the open. So flat day yesterday, net. The price that proves the stock market right or long would be if it breaks out above the 2-day high. The price that proves the stock market bearish or selling would be a loss of the previous day's low. Brings me to a really important coaching tip. When you're looking for good trade setups, it's particularly important that you focus your energy, as I do for my live room members, at breakouts above new highs. So for example, this is just so you can see what my members got yesterday. Every single day before the opening bell, I put up what I call an answer key to the market that has specific long and short triggers identified before the market opens and updated in market. For example, Uber did a drop and then a bounce. So we correctly called the short on the way down and the bounce on the way back up. But anyway, that's one thing that I've ran my live room here for 20 years now, since the year 2000. And the reasons why I've been one of the most successful long-running rooms with thousands of traders trained over the years is we avoid the cheap pop and drop, front run, crappy under $10 stocks. Occasionally I'll bring something up like EYEG, something that's the day's biggest volume mover pre-market. And so we do follow one or two of those each day, but I really like to focus our traders on successful alerts with instruments that have better trade potential. So that's a good example of a 2-day high breakout pattern. A good example of a gap fill winning call alert that I posted pre-market for everyone. After this Pacific Storage gapped down and started to bounce, I said we want to go long if it gets over 1630. And I gave everybody these alerts, at 8:45, 45 minutes before the bell. So we got plenty of time to put together a daily trading plan and not do like these kids do video game hot games. Let's use hotkeys and trade thousands of shares of $3 stocks and pretend we're making $5,000 a day. That's a bunch of BS. The truth is you need to, like any professional Wall Street trader, have a trading plan identified. If you're a swing trader, put a lot of work into it over the weekend. Saturday and Sunday, do your research on your charts, look for relative strength breakout plays, use volume, high volume confirmation. If you close it at 2-day high on high volume, that's likely to gap up. Make sure that you do adequate prep work. Like my colleague Brian Tracy, who I highly recommend learning from, just for life in general, would say preparation is the hallmark of a professional. So what you don't do is just pull up one or two fast-moving gap, $3 pop and drop, one-hit wonder stocks that are likely to stop you out. What you want is consistency of trend. And I'm an expert at helping traders identify those. And in range or during the trading session, for example, Uber was one of our picks yesterday. It called it short at 29.8, was the pre-market alert. It was on my radar because the gap, we had a short call at 29.8. I said to cover it near the 29.4. We didn't get the exact bottom, but once it started to bottom, I then said, let's go long if it bounces back over 29.7. And then out at 30, right? So kind of navigating the ins and outs of these charts can be a challenge if you don't have the specific entries identified ahead of time. And actually what's worth trading. Somebody here this morning had mentioned GOOS. And the first thing when somebody mentions a ticker is I pull it up and say, hey, is this thing worth trading in the first place? And absolutely. do start to practice and experiment. The fact that we have zero commissions now, if you're a US-based trader with a lot of the major companies, my favorite recommended brokerage is Ameritrade, because you get Thinkorswim for free, so you don't have to buy extra charts like I do. I mean, I've got Thinkorswim too, but I've been using eSignal for 20 years, so I still use my eSignal. But in order, I'd recommend Ameritrade, then Fidelity, then Interactive Brokers. And I can't any longer recommend IB for day trades because they still charge commissions with their pro platform, whereas you get everything full service with TD Ameritrade is by far in a way the #1 pick now, because it includes the brilliant Thinkorswim charts, which were originally developed with the help of Tom Sosnoff back when he ran Thinkorswim. So brilliant guy and a brilliant platform. So Ameritrade #1, Fidelity #2, no commissions, and practice different strategies with the no commission brokers, whether it's intraday swing trading. We put on the trade early in the day and close it into the afternoon. Or if you're looking for open range breakout plays, like I'm fond of doing in stocks like US Steel. One of my favorite charts is AMD, is another one that often runs up as well. But anyway, you get a small gap up that breaks out above the previous day's high. You put your long in, trail a stop at maybe 20 cents behind the inside market, and on a pullback, it closes you out automatically with a nice, 30, 40 cent profit. So do trade these open range breakouts if you are a day or a swing trader. Hey, Steve. Question from Don, what are my thoughts on the upcoming holiday week? We tend to have lighter suppressed volume because people are taking long holidays, so typically that leads to lower volatility. But that's the case in general for holiday weeks. So the #1 rule, and I've proven this to be so effective, at least in my own experience, is simply wait for 2-day high breakouts and avoid any charts that are inside the previous day's range. I mean, I still trade them on occasion if, say, it does a big epic drop to the previous day's low off a whole number and then bounces, but that's not my typical approach. Normally, I just like to buy above the previous day's high. The #1 tip for trading markets is avoid trading on inside range S&P days, which are usually Mondays and Fridays, and on occasion any day. But if the market itself is trading or opening, if the S&P is opening inside the previous day's range, stay clear of trading that entire day because you get many more stops. I've done over 8,500 trades, real money trades, this past 12 months with P&L proof from my Fidelity Sapphire brokerage account. And one of the things I've learned in that is how to avoid false breakouts and iffy charts and instead stay in on the charts that are most likely to potentially produce the biggest gains in the fastest amount of time with the best consistency. And that's not your pop and drop $3 biotech stocks or low float crap gaps that usually do the biggest move before 9:30 lately, right? So instead we want charts that are likely to run up all day long for us. And there's so many of them out there. Anyways, we're going to wrap up in just a minute. Anyway, just a point that this is one thing that differentiates my room from anyone else in the world is I give specific tickers and specific long and short triggers. Go long if it gets above here, get short if it gets under here. Each morning, reset daily. So you have a specific watch list of usually 5 to 7 stocks or so, and a couple 3 ETFs thrown in for good measure. And I do a lot of work for everybody. I don't just like follow 1 or 2 momentum stocks and hope it works out. Instead, I give very specific detailed intel before the market opens. So you've got specific entry triggers to practice with. And again, you can get access. I've got a sale going on for the next couple of weeks. Just $3.97 for 3 months, either PayPal or one shopping cart if you're not familiar with PayPal. And that's at my Trading the Open live room. And that's at tradingtheopen.com/3 winning months. So I do encourage you to take advantage of that if you're not yet a member. It'd be great to see all of you here. And I'm very conscientious. I usually, like here, I always show up early. I'm usually there at 8:30, 8:40, 8:45 at the latest, and I usually stay till at least 10:30, often 10:45 or even 11. If there's something worth trading, I'll stick around and walk you through with tape reading and 1-minute candlestick charts, very specific, well explained. You know, why did I set the alert here? Why are we exiting here? What's the reason for this chart being worth trading in the first place? So I run it like a live seminar, kind of a seminar online, not just alerts and a chit chatter and that kind of crap. I like to run it like a professional seminar online. So anyway, that's at tradingtheopen.com/3 winning months. Love to have you be a member, right? That's where you can learn so much from me, right? Or you can just join as a regular member, you know, as well. So the thing I like about our current markets is there's lots of profit potential if you know where to look and if you're headed in the right direction. Let's wrap up here in just a minute. I've got swing scans coming up with even better charts for my swing scans members. But whether you're trading steady uptrenders like CVS or the lower priced ones like ATRS, you got really good directional volatility. And it's kind of a parting thought too. If you trade options, I have a lot of options traders because I pick charts that have relatively consistent trends. And especially as swing scans for swing traders. If you do weekly options, you definitely want to be a member of Swing Scans. If you do stock and ETF day trading, you absolutely need to be a member of my live room. Because, you know, as you know, if you're an options trader, you have premium decay, you've got volatility that dries up, and the option expires worthless by the time the strike, before the strike ever hits. So if you want to hopefully turn that around, learn from people like myself that know directional volatility, that are experts, that have charts that keep running up week after week after week. That makes your life as an options trader much easier rather than buy a directional option like buying a call. It starts to get close, starts to run up, then it fades back down again. Option expires worthless and you're out some money. It's better to trade directional plays. So anyway, let's wrap. I think we're about out of time. It's been my sincere pleasure to have so many of you here, right? We finally broke the 5,800 mark in terms of people registered. So thank you for being here. Trade smart next week. Join my live room, 3winningmonths.com. Watch some of my playing tenor sax videos. I'm going to go play tenor sax this afternoon. I like classic jazz and 1950s rock and roll stuff and all that kind of stuff. I like real music, right? I don't like today's music much. I'm getting to be that old guy that likes, to me, modern music is like 1980s pop, right? Super modern is, you know, I don't know, Tiesto and Hardwell and some of the trance plays. But as a trader, you want to play music to your ears and make sure that you're trading the right kind of charts using an intelligent, rules-based approach that's very methodical, very consistent, very intelligent, and very risk-averse. By the way, for all of you who are new members or new visitors, I should say, here today, I like trading with small share size. Like my colleague Tom Sosnoff says, trade small, trade often. I say trade wide, not deep, and they're both correct. You want to re-enter after a stop and start off all, you know, for day trades, I advocate never day trading more than 100 shares at a time if you got less than 10 years experience. And if you got less than 10 years, I would say even 5 or 10 or 20 shares while you suffer through the learning curve, right? And learn how to not trade as your first step. Do that in paper or really small share size. And same thing when I'm swing trading. You know, like I've been trying to play this bounce in the pot stocks. I did so on very limited share numbers, under 100 shares or so. So that way, when they go up and down, if it goes down against me, I can stop out and it's not going to cost me much. When they do come to life and they skyrocket up, I can at that point then start to add to a winning trade. You always feed your winners and starve your losers, right? And the 2-day breakout strategy is something I teach to help with that. So you too, Damon. Have a safe and relaxing weekend. I appreciate that. Hey, Marcelo, yes, a reggaeton. And have a happy Thanksgiving to all of you. Appreciate it. Hey, Long, appreciate that. Hey, Oksana. Hey, Ali. Hey, Steve. Hey, Don. What's the best broker? Personally, I like, I use Fidelity because I'm trading my SEPARA. One of my SEPARAs in my Fidelity account, one of my Fidelity accounts. But my number one recommendation, because the charts are so spectacular, head and shoulders, the best charts you'll get are Thinkorswim on the Ameritrade platform. So TD Ameritrade is my number one recommended broker for day and swing trading. And if Interactive Brokers ever goes to where they're providing their pro platform at no commissions, then Interactive Brokers would be great too. But I like Ameritrade, Fidelity, Interactive Brokers, one of those three. Never open up an account in the Bahamas or Trinidad or some BS overseas tropical island where the SEC and the IRS don't like that. So don't break the law. And again, a parting thought, especially valid now that we've got no commissions, right? If you're at least a US-based trader, it's much more sensible to trade small share size with a commission-free broker than it is to try and you can do that in it. My point is, you can day trade, you can, I won't say beat the pattern day trading rule, you can be in compliance with it and still trade 5 times a day instead of 3 times in 5 days if you trade in a cash account and you're trading out of unsettled cash, which if you're a learning trader is completely appropriate. You do not want to use a big margin account and trade like I've done 50 or 60 times a day unless you know what you're doing, right? You can make so much money if you're good at it, but the challenge that you run into is that it used to be commissions will eat you alive. Now that's not the case, but it is a smart idea. Even if you have an account with say just $3,000 or $4,000 or $5,000, you can trade 5 shares or 1 share while you learn, as often as you still got unsettled cash. So make sure you set it up as a cash account or convert it. Just call them up on the phone and say, hey, can you make this from a margin into a cash account if you got under the $25,000, and you can still day trade 10 times or 20 times a day as long as you're trading in a cash account with unsettled cash, right, with the available cash. So that's something a lot of folks don't know. So another way to beat the PDT without having to resort to going overseas where it's dangerous. Any educator that recommends an overseas broker should not be trusted because they're getting paid off for referring clients and they charge enormous commissions and it's not compliant with the SEC and all the IRS and all the rest of it. So Ameritrade is your friend, or Fidelity, or Interactive Brokers. So go with somebody that makes sense. Anyway, take care, and I will see you all next time. Bye for now. Enjoy.